This is the #1 reason trading accounts run out so fast. You've probably seen it, or maybe even lived it. Account looks fine, a few trades later, it's margin called. The chart wasn't even that wrong. So what actually happened? In this video, we're breaking down the real reason accounts blow up so quickly. It usually comes down to lack of discipline. Let's build a better plan together. And it's not what most beginners think. The common assumption is that accounters think accounts get margin called from a string of bad predictions. In reality, that's rarely how it actually happens. You need a solid, tested plan to succeed. An account doesn't need to lose on every trade to blow up. One oversized position is often all it takes.
We're covering the real cause, out, why it's so common, and exactly what prevents it. Stick around. First, it's not about being wrong what prevents it on every single trade. A margin call happens when your account no longer has enough equity to support your open positions. And the broker starts closing them to protect against further loss.
Most people assume this comes from a string of wrong predictions. It usually doesn't. Here's the real #1 cause: oversized position size relative to account equity. This is the single one cause, most common thread running through fast account blowups. Traders open positions that are far too large for their account size, which means even a normal, expected market pullback can trigger a margin call. Even if the overall trade idea eventually would have worked out. And here's why leverage makes this danger idea of. Leverage lets you control a large position with a relatively small amount of capital, which means the margin required can shrink fast if the market moves against you, even slightly. Let's talk about why this mistake is so common. Reason 1. It doesn't feel risky in the moment. Opening an oversized position doesn't feel reckless when you're doing it. The chart looks convincing, the setup feels strong. Just this once feels tempting. The risk usually isn't obvious until the market moves the wrong way, even briefly. Reason 2, leverage makes it easy to size up without realizing it. It's easy to open a position that looks small in lots, but is actually massive relative to equity. A trader might glance at 0.1 lots, and assume that's conservative, without checking what percentage of the account it actually represents. Reason 3. Wins reinforce the habit. If an oversized position works out once or twice, wins, it reinforces the behavior. The trader starts associating bigger size with bigger wins. Without realizing the same behavior is one bad trade away from wiping out weeks of progress. So these 3 reasons are basically why this mistake keeps happening, even to experienced traders. But don't worry, because we can easily fix this with strict discipline. It's not about intelligence. It's about habits and blind spots. Now let's talk about how this actually leads to a margin call and what fixes it. When a position is too large relative to account equity, even a small adverse move eats through your margin buffer fast. The broker isn't targeting anyone personally, it's simply protecting the account from going negative. Once equity drops below the required maintenance margin, positions get closed automatically. Often at the worst possible moment, right as price is about to reverse. So here's solution 1. Size positions based on account percentage, not gut feeling. Before opening any trade, calculate position size based on a fixed percentage of account risk. Commonly 1 to 2%, not based on how big a position feels right. Solution 2. Understand margin usage, not just lot size. It's not enough to look at lot size alone. You need to understand how much margin a position actually consumes relative to total equity. Solution 3. Leave room for normal volatility. Markets move in both directions before eventually trending. An oversized position leaves no cushion for this normal back and forth,
which is often exactly when the margin call gets triggered, right before the move you predicted.
Always stick to your trading plan. Solution 4. Treat leverage as a tool, not a shortcut. Leverage isn't inherently dangerous, but using it to open oversized positions almost always ends the same way. Traders who last tend to use leverage conservatively, keeping actual dollar risk in check, no matter how much buying power is technically available. Let's make this concrete with 2 traders, same account, same analysis. Trader A opens a position sized so a normal pullback only uses a small part of their margin. Price dips slightly, then continues up. Trader A stays in the trade and eventually profits. Trader B opens a much larger position on the exact same setup, using far more of their available margin. This can lead to massive losses. The exact same slight pullback happens, but this time it's enough to trigger a margin call. Trader B gets closed out right before price does exactly what they predict. Same analysis, same market move, completely different outcome. Purely because of position size. So here's the bottom line. Margin calls rarely happen because every trade was wrong. The real #1 cause is oversized position size relative to account equity. This mistake is common because it doesn't feel risky, and leverage hides the real exposure. The fix is sizing by account percentage, understanding margin usage, and leaving room for volatility. To succeed in trading, you need a solid plan. Simple principles, but they make all the difference. If this helped clarify why accounts get margin called so fast, share it with a trader friend who's had this happen. Drop a comment. Has price ever reversed right after you got stopped out or margin called? Thanks for watching. See you in the next one.